It's official.
This is the beginning of a full-blown rate cut cycle
that could reshape the entire U.S. economy.
America's $37 trillion reset begins.
Last time the Fed made a move like this, it unleashed a chain reaction.
Asset prices exploded. Debt soared.
And the dollar collapsed under its own weight.
History doesn't repeat, but it rhymes.
And if this isn't the next rhyme, the clock just started ticking.
Before we dive in, hit that like button if you don't want to be left behind.
Because what you'll see in the next 5 minutes might change how you think about money.
When stocks, crypto, gold, and real estate are already near all-time highs?
Simple. Behind the curtain, the U.S. economy is slowing faster than anyone expected. Over 1 million federal workers are still furloughed.
Job openings are falling.
Small business hiring is down 7%.
The so-called soft landing might be softer than we thought, or not a landing at all.
Despite every bearish headline, the S&P 500 has climbed over 30% from its April lows. But when the Fed cuts rates this close to all-time highs, history shows volatility explodes.
Yes, the stock market tends to rise another 13% on average, but it also suffers massive 15–20% swings.
Remember, the last 3 rate cut cycles, 2001, and 2020, each led directly into a crash. Every fluctuation represents a fortune won or lost. In moments like these, the line between collapse and opportunity is razor thin.
Volatility incoming.
Meanwhile, the housing market is whispering a warning.
Home values are slipping for the first time in years, down 1.7% year over year.
Yet 30% of homes are still bought in cash.
And average down payments hit a record $70,000.
The rich aren't leaving the market, they're buying the dip.
And then there's the part no one's talking about.
The end of quantitative tightening. Imagine the economy as a swimming pool. For years, the Fed let the water evaporate. Now, they're topping it off again. Translation: the money printer is turning back on. From quantitative tightening to quantitative easing 2.0.
Translation: political pressure to keep cutting rates could intensify.
Which means This pivot isn't just economic, it's political.
The more liquidity returns, the more pressure hits the dollar.
Gold, Bitcoin, and hard assets are already surging.
Inflation isn't gone to pay. It's waiting.
The question isn't if prices rise again, it's when.
%20 in cash, earning 4% tax-free in muni bonds.
Steady buys into the S&P 500 and emerging markets.
And yes, a small Bitcoin ETF position that I DCA weekly.
Discipline is key. By automating your investments, you ensure your future grows alongside the market's opportunities.
Because when the Fed pivots, volatility is opportunity harvesting. And the real winners are the ones who stay disciplined.
The question is, treat you of us. Have you made yours?
Let me know your thoughts below. I'll be reading every comment tonight.
While some see uncertainty in the shifting markets, others find opportunity. Don't just watch history, trade it.
Navigate the uncertainty and seize the opportunity. Join our community by subscribing now.
Every decision made within these walls sends ripples across the globe.
But this time, the ripples are set to become waves.
For the average person, this isn't about charts and graphs.
It's about the cost of living, the price of stability.
Understanding these forces is the first step to protecting yourself.
Lower rates are designed to encourage spending, to stimulate growth. But they also make debt cheaper, encouraging leverage and risk.
In the markets, this creates a paradox. Short-term euphoria, masking the potential for long-term pain.
This is why a balanced approach is crucial. You can't afford to be all in or all out.
Think of it as a portfolio that can weather both the storm and the sunshine.
The housing market reset isn't just a statistic.
For some, it's a long-awaited opportunity. For others, a painful loss of equity.
The key will be identifying value in a market undergoing a fundamental shift.
The return of quantitative easing has one major, unavoidable side effect.
The debasement of the currency.
This is why your cash needs to be working for you, not just sitting there.
Every day it sits, its purchasing power is eroding.
The political dimension cannot be overstated. An independent Fed is the ideal, but reality is often far more complicated.
International investors are watching closely. A politicized Fed could accelerate the move away from the dollar.
This is the narrative driving assets, like Bitcoin.
And timeless stores of value, like gold. So let's recap the strategy. Safety, growth, and a touch of disciplined speculation. 1. Secure cash fight. 2. Core growth fight. 3-point asymmetric bet fight.
It's not about predicting the future. It's about preparing for multiple possible futures.
Discipline is your anchor in a sea of volatility.
Devil functions. There will be days of incredible gains.
And days of gut-wrenching losses. Your plan should account for both. Emotion is the enemy of a good investor.
The winners of this reset won't be the luckiest. They will be the most disciplined.
The first move on the chessboard has been made.
A cycle has begun.
As the day ends, new opportunities arise from the uncertainty.
While the markets remain uncertain, the opportunities for growth are clear. Subscribe now to unlock exclusive insights and watch our next analysis. A look back at the volatility, inflation, and the Fed pivot. What this means for markets, growth, and strategy.
The markets never sleep, and information is your greatest asset. Stay informed. Stay disciplined.
And unlock the opportunities that others are too afraid to see.
For every challenge, there is an opportunity.
For every reset, a new beginning.
The landscape is changing.
Thank you for watching. Don't forget to like and subscribe, and click here for more strategies on navigating the global market.